Joining us now to break down the 2025 setup is CNBC contributor Adam Parker of Trivariate Research. Adam, great to see you. Thanks a lot for coming on. As we get to the end of the year, I'd be really interested in your thoughts thematically on whether any of these trends that have been so entrenched will continue or are ripe for reversion next year. So you have passive over active. It's been really hard to beat the market. You have large stocks over small stocks. You got growth over value. You got U.S. over the rest of the world. All of those things seemingly at extremes, yet it seems tough to bet against them at this point. How would you come down?
Yeah, I mean, I'd take each one at a time, Mike. And thanks for having me. Happy New Year, by the way. Look, I think the U.S. versus the rest of the world. Look, you know me, Mike. I just think the U.S. has a superior set of assets, and so unless it's a huge change to the corporate constitution of the other countries, I like the U.S. the most. Growth versus value is tricky, right? Because there really aren't that many mega large cap value stocks in the whole universe. It's hard to even be a diversified manager. So if you're trying to beat the S&P, you probably have to own 2/3 growth to beat the S&P. So I think that trade's probably entrenched too. I thought last year had, like Q3, if you look at Q3 of 2024, it had huge breadth. I mean, the number of companies that beat the market by 20% or more over that time frame was at the highest it had been since 2020, and before that it was the tech crisis. So I think we had good breadth. People just whined about the Mag 7, but we still had plenty of stocks that were up a lot. So I think you'll have a little bit of a rotation. I think most investors I talk to think there will be, whether it's into laggards in healthcare, maybe where there's more onerous assumptions maybe embedded in those stocks in other parts of the market. Maybe industrials, where industrial activity has really been in a recession and industrial earnings have really been down, and maybe they're troughing and can grow in the second half of 25. And as you know, the market leads that. So I think you'll see some rotation, but I don't think it's going to be a wholesale change to the dynamics of the U.S. or growth.
And do the earnings forecasts that are now set up for next year feel like they're firm enough? I mean, through your work, does it feel as if we can reliably expect 10%-ish growth for most of the S&P?
So if you look at, as far as I'm aware, bottom-up earnings estimates from the analysts have existed since 1978. On average, on January 1st of any given year, the analysts' bottom-up expectations are for 14% growth, and the actual growth's been closer to 8%. So the market can absorb downward revisions as long as it believes earnings are going to grow in absolute terms. I don't think people really believe. I think the Q4 2025 numbers are 17% year over year versus Q4 right now. I don't think anybody needs to believe that those are achievable, Mike. It's just more whether results can be steady, that you can have earnings growth accelerate in the second half of next year. That should be enough. I think there's kind of a shorter-term 2025 view and then a longer-term view that you have to think through. But I think 8% is a reasonable long-term earnings growth assumption for the S&P.
I know that you set out a bunch of, kind of conundrums or vexing questions about the market to clients recently, including one that was, when is it okay or when is it going to be time to fight the Fed? And I find it interesting right now, because what would it even mean to be fighting the Fed at this point, right? Usually that means, look, if the Fed's cutting, don't get in the way of that. They usually get what they're looking for. But right now, they're kind of cutting, but less than expected, and maybe the rates are going to settle above what we thought. How does that filter into the process here?
Yeah, I do think if you look at the things that were part of the bull case a year ago, when we did our kind of, bullish outlook for 2024 a year ago, we thought, the Fed accommodation is going to be there. It's going to help you on the front end, and you don't want to fight the Fed. But what we learned in the last cycle, if you think back to the last cycle, tech stocks got killed in 2022. Everyone's favorite, Nvidia and Meta, were really bad stocks in 2022. And if you were a genius, you covered your shorts basically this day 2 years ago and got max long on Jan 1 of 2023. And the reason you did that ex post was because the Fed was closer to being done hiking. And so you could kind of envision the end of the hiking cycle, right? And so that was the end of the, kind of multi-compression. Well, if we take that logic and sort of flip it on its head and say, okay, well, I don't want to fight the Fed while they're cutting at least the first half of the cycle, but as we get closer toward the end of the accommodation, maybe I can fight them. I think the answer is kind of now, right? Or it's getting close to being now, that you're not sure if they're going to do another 75 or 100 bips or that's it. And so I think you don't have as powerful of a bull case from the Fed side as you did 6 months ago.